Welcome to the Daily Brief, where I'll go over the action in the market for Monday, February 6th, and then we'll see how things look for Tuesday, February 7th. Not really a surprise that we saw a bit of a pullback. What we're really watching for is, if we continue to pull back from here, is the environment going to switch to a more negative stance? Based on what we saw on Monday, we're really just chopping sideways. We're working off some overbought conditions. We didn't really do any technical damage to the market. So right now, things are still looking positive, but we're going to be watching that to see if that changes. So let's go back and talk about what happened. Right at the open, we had a gap lower open below S1 at 41.12. Then as the day went on, prices spent the rest of the day going above and below S1. So it was really kind of a yawner. At the close, we were down 0.61%. Volume did drop to below average. That can be somewhat encouraging. We had a down day. Volume pulled back a bit. Not a lot of technical damage was done. So far, the positive scenario seems to be holding up. The market is still really fixated on inflation and interest rates, but we didn't really get any news surrounding that. There may be some things coming out on Tuesday that I'll go through. The geopolitical concerns, of course, the big talk in the news in the U.S. right now is about the balloon that was shot down over the weekend. That would not necessarily have an impact on the market, but things like Russia-Ukraine, that could. Escalation with China, that could. Situation between China and Taiwan, that could have an impact as well. And then the earnings are being released. We still are kind of the latter half of the earnings season right now, so we have a lot of reports coming out. And then the debt ceiling, which doesn't seem to be resolved currently. Here's the intraday chart showing how we gapped lower. We went down to S1 right off the bat and then spent the day there. We went a little bit below, a little bit above, but pretty much stayed along this time the entire session. What are some comments that we can make? Growth held up better than value in Monday's session, and large caps held up better than small and mid caps. We've been seeing value still pretty strong, and we've been seeing small and mid caps strong. Those three areas fell back on Monday, where growth and large caps held up better. On Tuesday, Chair Powell will be giving a speech, and I have that at the end of this video where I talk about any Fed speak that's coming up. It shouldn't spook the markets too much if he says the same things that he said last week. The scenario that we're going with is that the Fed funds rate will be at 5 to 5.25 by early May. That includes 2 more 25 basis point hikes at the next 2 meetings. Then the idea is that the Fed will keep it at that level until inflation falls down to 2%. Sounds really easy. Now we'll see if that can actually happen. The S&P has generated a golden cross. That was at the end of last week. We have to ask ourselves, can that last? So far, after Monday's session, 4,100 held. On a short-term basis, we still have some of our stochastics that are looking extreme positive. In the intermediate term, we have the Sean Trend Meter and the CCI 20. They're still extreme, but they are falling. And then longer term, we have the moving average study. The 150 and the 200 are still looking rather extreme. And I'll show you charts of all of these. The dollar was up and interest rates were up. We want to keep an eye on the dollar. The weakness that we've seen in the dollar has been one of the stimuluses for the stock market. If it starts to go back up, is that going to produce some headwinds for the stock market? We also want to keep an eye on interest rates. If they really start to go up, that could also have a negative impact on the stock market. The 10 to the 5, the 10 to the 2, the 30 to the 5, the 10 to the 3-month, those yield curves remain inverted. Sentiment is still extreme positive. We're right on that border at 75. We didn't have any economic reports in Monday's session. Our trend is still positive and getting stronger. We're above the moving average. We're also slightly above 20. I have switched our bias over to negative, and I've switched our momentum back over to mixed. We had 2 down days now. In the short term, for the bias, we would be negative, but we're still looking positive overall, so that's why I've kept the momentum at mixed. Here's a screenshot just showing how large cap value on the left, it was down 0.62%. Large cap growth was down 0.55%, so it was down less, so it outperformed. Mid caps and small caps saw some pretty sizable losses in Monday's session. This core area in the middle are just the ETFs that go with the large, mid, and small caps. So that's why I don't really focus on those as much, because we look at those at other times throughout the video. The Ulcer Index actually dropped a little bit even on a down day. It's just showing that we're really complacent currently. That could be a warning sign where if the market really starts to fall, you have a lot of people that are asleep at the switch because they're complacent right now, and that could produce a lot of selling, but we're not seeing that right now. The VIX was up on a down day, which is more normal, but we're still below 20 on a closing basis. We ticked back up a little bit on the bar chart. The ADX is suggesting that our trend is still intact right now. It's rolling over a little bit because we had the down day. The ADX right now is being calculated off the positive things that it's been seeing. If we see more decline, this could turn the ADX back lower. The green line is on top, so we default to positive, even though things are pretty sleepy currently. Here's the daily chart, how we came right up to this R level. We're also right at resistance and coming back down. We came back down to the December highs and we closed just slightly above that. So that is positive currently. This red line, which is acting as support. Looking at our moving average study, we're declining with the 20 and 50, even though the 50 turned up just a little bit. And the 200-day exponential moving average continues to fall. Here's the stochastics. We're coming out of extreme positive readings in the short term, but we're still extreme positive, even though we're declining in the intermediate short term. Long term, we're starting to roll over and coming down. So we have the intermediate term declining, but it's still extreme positive, and the longer term stochastic is still extreme positive and hasn't quite rolled over yet. Our slope, we're keeping an eye on this. This is the only one of our oscillators that's misbehaving right now, where it might be turning back more negative, but we're not seeing that in any of our other oscillators. The BPI is still looking a little extreme positive. It's above 70, but you could also say that this is positive momentum as we've been going higher. The NYSE bullish percent index, after breaking out above the August highs, it rolled over just a little bit, but is still looking positive. The Chaikin money flow down a little bit, but still hanging in there. Here's the CCI 14. We're no longer extreme positive. The CCI 20, another day, and this likely will drop below the extreme positive reading. The CMB composite index, after giving us a little bit of an extreme positive reading, has turned back down. It's now crossed below this red line. That is a sell signal. If we cross down below the green line, that would confirm the sell signal. This is a little shorter term out of the box trading strategy. TTM squeeze, we still have the bars at a darker shade of blue. That is more neutral to negative, but still holding up overall. The double and triple exponential moving average chart still shows the red and the blue line going up. We're coming back down. We could hit this anchored moving average going back to the all-time high. This is currently at about 40.85, so we'll be watching that level. On a short-term basis, after coming back up above the 100% retracement, we've fallen back down. If we try to go back up, this may act as resistance. If we continue to fall, we've got quite a ways to go at the 4007 level. The rate of change going back 20 periods is no longer extreme positive. Here's a new chart. Over the weekend, I was just looking through some things and drawing some lines on the chart, and I went, wait a minute, this is kind of interesting. I included this in the weekly video because I do that a little bit later. I try to get the daily video out just as soon as possible, so anything that I find over the weekend, I don't really have a chance to talk about until I do the video for Tuesday. But when you measure from the all-time high in the S&P going back down to the low, if October ends up being the low, we have been able to retrace 50% of that decline, and that's at the 4,053 level. We came right up to that level, and now we're coming back down. So we want to keep an eye on this area as well. Longer term, we still have a couple of fib levels at about the 42.13 level. That's still a ways away from where we're at. If we continue to fall, we're looking at about the 40.20 level, and we've been watching that level for quite some time. Another thing that's interesting is the NASDAQ 100, after going to the all-time high and then down to the October low, this has also retraced 38.2%, and it bumped right up to that level and has since been coming back down. So if we turn and go back up, we're looking at about the 12,868 level, just around this number up. The swell trading oscillator based on price and volume is pretty much sideways with the price and with the volume. Moving average tree, we're still above all of the moving averages, and the longer we can stay above them, the more these will turn up and look a little more positive. The Elder Impulse system for the S&P is still at neutral. It switched to neutral after Friday. McClellan Oscillator did drop down below 0, so that's slightly negative. The Summation Index based on price rolling over a bit, and we're turning down based on volume after hitting this other extreme level. So we'll want to keep an eye on that to see if it really changes things. The Sean Trend Meter, after giving us an extreme positive reading, it's still extreme positive, but if it drops down below this red line, it will go back to not being extreme. New highs, new lows. Didn't really see an expansion of new highs or new lows in Monday's session, so our 5 period is rolling over a bit, but it's still positive, and we're going up slightly with the 10 period. Looking at the advanced decline line, with the down day, we saw a bit of a decline based on price and volume, but so far this is hanging in there. The Copic curve still hasn't fallen back over the moving average to stop the buy signal that was generated in the first part of January. Here's the longer-term moving average study. The 150 and the 200, they continue to be extreme positive, but are declining. The Dow is still above the pivot level. As long as it stays above that, that's positive for the month, and it's still above the 50-period moving average, which is now acting as support. The diamonds are still neutral. The Nasdaq, after breaking above the 200-day moving average and going up above R1, has now fallen back below that. And the Nasdaq, kind of the same thing, above R1, and is now retracing back. The Q's Elder Impulse system is still neutral. It turned neutral after Friday. The small caps still looking good. We came up above R1, but have since fallen back. And the mid caps, after hitting R1 as resistance, have now fallen back a bit. The Wilshire, I bring this up because we're just about ready to give a golden cross here. This is a broad market measurement, and to have this turnover and give us a golden cross would be positive. The home builders pretty much moving hand in hand with the S&P. We were down with the S&P in Monday's session, so the home builders were down. The ratio still is holding up fairly well, and they're having a tendency to go in the same direction. I wanted to bring this up at the dollar because even though we're in a downtrend, we've seen 2 strong days, Friday and Monday, where the dollar has really bounced back up. That could produce some headwinds if we continue to go higher. Treasury yields, after trending down for the most part, again in Friday's session and Monday, really saw a spike up. That could produce some headwinds as well. Looking at our possible positive scenarios, we're still looking okay with the 50-period exponential moving average of the new highs minus the new lows. We're still in this upper area. It's not blue yet. We haven't been there long enough for me to put that in there. But other times when we come into the blue area, that gives some really good support to the S&P. Here's that same chart just showing the actual indicator and then the moving average plotted on top. We're still above this line, so that is positive. Another one that I haven't shown in a while is the 10-day average of the highs and the lows in the S&P. We're starting to get a little extreme positive here. We came back up to this level after Friday. We've dropped down a little bit, but we're still above the 90 level with this reading. That's the negative side where it could be coming down. The positive side is that we've been able to move up into this area on pretty good momentum. Looking at the 5-period moving average of the highs minus the lows, we're above 0 and still hanging in there overall. It's going up. The 3-month to 7-year bonds in a ratio against the investment grade bonds still shows that we are overall decreasing in fear, where it says economic fear increases and decreases with the chart. As this is going down, that means fear is decreasing. It turned back up in Monday's session, but it hasn't gone back up decidedly yet. The staples to S&P 500 spike after really coming down came back up in Monday's session, but we're still coming down overall. So this is still looking like a viable spike. I'm going to include some additional charts that are much longer term, just to give an idea of where we're at in the much bigger picture. These are some charts that I've been showing recently. This is the NYSE composite on top, but this is a monthly chart and showing the Copic curve. We use that in the daily and weekly charts, and we're working off of buy signals. On the monthly chart, if this can turn back up and get above this moving average, that would be positive for the NYSE, which is a broader measure, which also would be positive for the S&P 500. And you can go back and look that when we drop below this dash line and then turn back up, that often provided some really good support for the market. Here's the NYSE composite again in the top, and this is the NYSE record high percent index. When this is coming down and we hit kind of an extreme level and then turn back up, that could also provide a lot of support for the S&P 500. Here's the S&P 500 on the top, looking at again at a monthly chart, and the percentage price oscillator, the PPO. That's one of the oscillators that we use. This is much longer looking with the monthly chart where it's turning back up also, and that could give some support to the S&P. Here's the S&P 500 ratio against the CRB index. This is also starting to turn back up. And the S&P 500 against the Dow Jones Global Index, again a monthly chart, we're rolling over a bit with the KST. We'll want to see if that can turn back up. But as long as we stay above this red line, that means the S&P 500 is outperforming. And if we can turn back up, that would be even more positive. So what's our outlook for Tuesday? The technicals are positive. We're still above support. I've switched that. Instead of calling it resistance that we're above, I've gone ahead. We've been above that trend line for quite a while now, so we're above support. Working off being short and intermediate term overbought, we're watching for a possible reversal. If this really gets going to the downside, is that going to do a lot of technical damage and actually change the environment back over to being negative? We have the trade balance report coming out on Tuesday, as well as consumer credit. Then the whole list of geopolitical events. Mainly the markets are fixated on inflation and interest rates, which are also producing the earnings per share concerns as well as valuation concerns. Earnings as they're released by each company. We will be getting some Fed speak on Tuesday that I'll address here in just a minute. And then we're waiting to see if anything is handled with the debt ceiling. Looking at the Stock Trader Almanac statistics, the one I'm really going to focus on for this video has to do with the daily statistics showing how the Dow, the S&P, and the NASDAQ are neutral to negative for Tuesday's session because they've only been up 47.6% of the time. We're still working off of this 3-0 trifecta, and we will be doing that for the entire year, and the market still likes that we're split between Republican and Democrat. We do have the State of the Union that will be coming out on Tuesday. Not necessarily a big mover in the market, but still something that might be interesting to keep tabs on. Then the Fed speak. I went to their site and looked at their calendar, and we have numerous speeches being given this week. On Tuesday, Chair Powell will be giving a speech. Here's all the details. I won't read that off. We also have Michael Barr giving a speech on Tuesday. Then on Wednesday, Michael Barr, who's busy these days, is giving another speech. And then on Friday, we have Christopher Waller, who will be giving a speech as well. Our scenarios can't really go with the down one yet because we're not seeing a lot of confirmation of downward movement. The technicals are still positive overall. We're above support, and we're working off being short and intermediate term overbought. Hard to go with the up one. You could, but it goes against my basic philosophy that you only get into the market using a trend-based strategy when the market is going in the direction of that trend. If you're looking to go up, we had a down day, so you would not have executed a new position, at least according to how I see things. I know that goes against how a lot of people teach that, oh, you want to get it at 10? Well, put in an order at 9.5. I understand why people do that, but it goes against almost all logic, and it's probably why most people don't succeed when you actively trade the markets. So it's hard to go with that one unless we have an up day. We could still go with the sideways trend because even though we're above 20, we haven't seen an up day since the ADX went above 20, even though it's getting stronger, but it is positive with the green line on top. Our conclusion, the S&P is positive. It's above support, working off this overbought condition, and we're waiting to see if things continue on the downside to change the climate. Short-term positive and working off the overbought condition as well as the intermediate term. Long-term, we're positive because we're above the 200-day moving average, and we just saw a recent golden cross that we're waiting to see. Is that going to be valid, or is that going to be a whipsaw or a false signal? Thank you. I hope you found this helpful. Please feel free to let me know if you like some of the new charts that I've been adding. They're much, much longer term, but if we get some context behind are we in a negative or a positive backdrop, I think that helps when we look at the shorter term time horizons. So have a good day, and I will talk to you in the next video.